March 14, 2026. As the regional crisis in the Middle East enters its third week, the global economy is no longer just adjusting, it is fundamentally transforming. We are witnessing the birth of what economists are calling the strategic shift economy. While initial projections focused on a quick resolution, the reality on the ground has forced a massive pivot in American fiscal policy. President Trump, once a staunch advocate for record low energy costs, has introduced a new narrative that the current price surge is a necessary investment for long-term regional stability. But as the numbers come in, the question remains, can the global market sustain this level of pressure? The heart of the volatility lies in the Hormuz corridor, with nearly 20% of the world's maritime energy supply currently restricted. Brent crude has established a volatile floor near $100 to $110 per barrel, with brief peaks hitting $119. Financial institutions like Goldman Sachs warned that if these levels persist, a global cooling of the economy is inevitable. Yet, the administration's stance has shifted by framing high prices as a boon for domestic shale and fracking producers. The White House is attempting to turn a consumer crisis into an industrial opportunity, however. This domestic boost comes with a diplomatic cost. To ease the immediate supply shock, the U.S. has temporarily adjusted trade restrictions on external energy sources, a move that has sparked intense debate among European allies regarding the redistribution of global energy revenue. On Wall Street, the reaction has been one of guarded anxiety. The major indices have seen their sharpest declines of the year as investors migrate toward safe haven assets like gold and treasuries, but the real impact is being felt at the kitchen table. We are seeing the rise of supply-side inflation because energy is a core component of transportation, packaging, and fertilizer. The cost of everyday essentials from groceries to electricity is spiking. This has put the Federal Reserve in an impossible position. With inflation trending upward, the prospect of interest rate relief has vanished, sending mortgage rates to new highs and cooling the housing market. Then there is the direct cost. The first 6 days of regional security operations alone carried a price tag of over $11 billion. That's a burn rate of nearly $1.8 billion per day. Beyond the hardware and personnel, the State Department is managing one of the largest logistical challenges in history, the coordinated return of thousands of citizens from the affected zones. As we head toward the 2026 midterm elections, these figures are becoming the focal point of a heated national debate. The ripples of this crisis even extend to the world of sport. With the 2026 World Cup scheduled for the summer, the Iranian national team's participation is now in doubt due to evolving security protocols. It's a reminder that in 2026, there is no corner of the globe and no sector of the economy untouched by the current shift. Is this the new normal, or the prelude to a deeper recession? Only time will tell. Subscribe for the latest global economic updates.